Are you in debt and thinking about starting an IVA? Well, before you do, you may want to listen to the experience of somebody who has been there, done it, and who would personally not recommend it. Want to know why? Then watch on. Hi, my name is Simon and I create content on business, building wealth and personal development. If you haven't done so already, then please click the subscribe button down below and hit the bell icon to be notified of all new uploads. Okay, so let's get started. So if you're thinking about entering into an IVA to clear your debt, then you probably already know what an IVA is. But for those of you that don't know or are not quite sure, here's a brief outline. So an IVA, or Individual Voluntary Arrangement, is a government legislated scheme designed to help you clear all unsecured debts that you can't afford to pay back. It was introduced by the government as part of the 1986 Insolvency Act as an alternative to bankruptcy to protect your assets. An IVA can only be set up by a licensed insolvency practitioner, or IP for short. An insolvency practitioner is effectively somebody who is licensed and authorised to act in relation to an individual's debt. Now, most insolvency practitioners are accountants or insolvency specialists working in IVA companies. Insolvency practitioners do have guidelines to follow and must adhere to the law, but that doesn't mean that they won't take advantage of you or your situation. So be sure to look at other options to clear your debt before going ahead with an IVA. Now, my experience and that of many others who use the same IVA company that I used is that they have absolutely no interest in their customers. They don't care if you're struggling or at your wit's end, and they don't care if you do not have enough money to live on for the month. They just want to make as much money as they can from their clients, and they don't care whatsoever about you. Now, this was obviously my experience. Your mileage may vary, but I will provide information about who I used and my experience at the end of the video for those of you that are interested. How do you qualify for an IVA? Well, to qualify, you must be insolvent, that is, not be able to pay your debt, have a minimum debt level of £5,000, have a minimum of 2 creditors, have a regular income, have the ability to pay a minimum of £80 per month into the IVA. An IVA should offer a higher return for your creditors than bankruptcy. You must reside in England, Wales or Northern Ireland. Those of you who live in Scotland will need to look at a trust deed. What debts can and cannot be included in an IVA? You can include the following debts in an IVA: catalogue accounts, personal loans, overdrafts, credit cards, arrears on utility bills such as gas, electric and water, council tax arrears, payday loans, store cards, income tax and national insurance arrears, tax credit or benefits overpayments, debts to family and friends, any other outstanding bill, for example solicitors' costs, invoices for building work and veterinary bills. What debts cannot be included in an IVA? Mortgages and secured loans, hire purchase agreements, court fines, TV licence arrears, student loans, child support arrears. Can joint debts be included in my IVA? A joint debt can be included in an IVA. However, the other person named on the debt will still be responsible for making payments towards it. If you have some of the other debt written off, the other person will still be asked to pay the remaining money back. If you have a lot of joint debt and are thinking about entering into an IVA, then there is always the option of taking out a joint IVA. How long will an IVA last? In most cases, an IVA will last for 5 years, assuming that you are a homeowner and can release equity from your property at the end of the 5th year. If you are not a homeowner or cannot release equity for any reason, then the IVA will be extended for a further year. I am a homeowner, will I lose my home? Your home should never have to be sold, although you might have to release up to 85% of any equity in your property. However, the IVA's impact on your credit rating might mean that a new mortgage is harder to find and potentially more expensive. This is the problem that I encountered. My existing mortgage company wouldn't allow me to remortgage, and any new mortgage lenders wouldn't touch me because my credit report was so bad due to being in an IVA. It's a double-edged sword. My insolvency practitioner wanted me then to try and take out a secured loan against my property in order to pay back the remainder of the debt owed to the creditors. They effectively wanted me to get into debt to pay off debt. Have you ever heard anything so ridiculous? So what happens if you are not a homeowner or cannot release equity? Well, if you do not own your own home or you cannot release equity for any reason, then the insolvency practitioner will review your circumstances, propose a variation to the creditors, and your IVA will be extended for a further 12 months, assuming that the variation is accepted. Your payments will stay the same or might be adjusted accordingly depending on whether you're earning more money or less money than you were at the start of your IVA. If you do meet the criteria, what happens next? If you meet the criteria and assuming that you want to go ahead with an IVA, then the next step is for the insolvency practitioner to send you an income and expenditure form to complete. From this form, the insolvency practitioner will then calculate what you can realistically afford to pay to your creditors each month to reduce your debt. Expenses are calculated using a set of budget guidelines that seem to be fair to both you and your creditors. Now, I don't know if it was fair, but in my experience, the insolvency practitioner was incredibly strict about what were and were not acceptable expenses. The guidelines cover all expenses so that your IVA monthly payments will be as accurate as possible. These can be broken down into two areas: priority expenses and household expenses. Priority expenses cover such things as mortgage or rent payments and HP payments if you have a vehicle. An IP might consider an expense excessive if, for example, 40% or more of your disposable income is required to pay the mortgage or rent. Similarly, if you have acquired an expensive car via an HP agreement, creditors may suggest that you sell your vehicle and look at alternative arrangements. This is what they suggested to me. Household expenses include guideline amounts for such items as household bills, food, toiletries and clothing, but they also take other expenses into account such as childcare, car maintenance, hairdressers, internet payments, mobile phone payments, dental care and so on. This is where the IP will really tighten the thumbscrews. They made me reduce my internet to the basic package. Now they would have actually made me cancel it if I couldn't prove that I needed it for work. They made me get rid of my Sky TV subscription, change my mobile phone from a contract to a pay-as-you-go account, and cancel any other subscriptions that they deemed to be unnecessary. There was absolutely no allowance for entertainment such as eating out, hobbies and socialising, but this has since been changed to £20 per month. Holidays are a definite no unless you can afford to save for a holiday from the tiny amount that you're allowed for hobbies. You can forget about a budget for tobacco if you're a smoker unless you can justify it, and just saying that you're a smoker is not justification enough. You might also need to look at cutting your own hair every now and then because the allowable expense is around £12 per month. Now even I spend more than that in a month and I've barely got any hair to cut. As you can see, if you're thinking about taking out an IVA, you will be on a very, very tight budget and you will find it very, very difficult to live this way for 5 or potentially 6 years. Let's assume that you have unsecured debt of £30,000. You earn £2,000 per month and you work out your total expenses to be £1,750 per month. Your payment would be calculated as £2,000 less £1,750, so realistically you could pay £250 per month into your IVA. If you were to be in the IVA for 5 years, then you would pay £250 times 60 months, a grand total of £15,000, which is 50% of your total debt, or as the insolvency practitioners like to say, 50p in the pound. But let's not forget that the IVA companies are not doing this out of the goodness of their own hearts. They will be charging thousands of pounds in fees. Now, most IPs are not very clear about whether their fees are put on top of your outstanding debt or taken from the debt. I think it's a mixture of both really. So to give them the benefit of the doubt and weigh things in their favour, we will deduct them from the debt. So to start, there will be a nominees fee. Now this fee is charged for setting up the IVA. This will usually be taken from the first 5 payments of your IVA. On top of this, there are ongoing supervisor fees, which are approximately 15% of your monthly payment. There are also other fees called disbursements that will cover such things as insurance to protect any money paid into your IVA, system maintenance fees and a registration fee to register the IVA with the insolvency service. Now I don't have the exact figure for this fee, so we will use a very generous arbitrary figure of £500, but I'm pretty sure it will be much more than this. So what you would actually pay to your creditors is £15,000 less £1,250 for nominees fees, £2,062.50 for supervisors fees, and £500 disbursements, which totals £3,812.50. So what you would actually be paying to your creditors is £15,000 less £3,812.50, which is £11,187.50. The rest goes to your IP. And this is assuming, as we've said, that fees are taken from the debt and not put on top. So that's the standard what you could hope to happen scenario. What's more likely to happen is that the IP will amend your income and expenditure report, cutting out all unnecessary expenses and making that payment much higher. So let's for argument's sake say they manage to reduce your expenses to £1,600. Your monthly payment would now be £400. That's £2,000 income less £1,600 expenses. £400 times 60 payments is £24,000. So you would now be paying back 80p in the pound, which is 80% of your debt, although 24% of this amount is fees paid to your IP. At the end of the 5th year, you would be asked to remortgage your property and release up to 85% of any equity you have in it. Now let's assume that you have £20,000 worth of equity in your property. 85% of £20,000 is £17,000. As you've already paid £24,000 into your IVA, you only really now owe £6,000. So you would likely have to pay all of that remaining debt from your equity. But really, you've only paid £24,200 off your debt. The rest is fees to the IP. And that's assuming again that fees are taken from the total debt rather than being put on top. Either way, you'll still be paying back 100% of the total value of your debt. If you cannot remortgage or you do not own your own home, then the IVA will be extended and you will continue to make payments for a further year. So you would either pay a lump sum into your IVA from your equity and your IVA would end, or you would make an additional 12 payments of £400, which is a further £4,800, bringing the total paid into your IVA to £28,800, less the IP's fees of £6,520. So you would have paid off £22,280 of your debt, which is 74%, but the total you paid into the IVA, including the fees, is 96% of your debt. So what happened to the supposed 85% of debt that can be written off? Now, I may have gotten these calculations wrong and I will be happy to be proven wrong. So if there are any IPs out there or IVA company workers, or indeed anybody who's been through this themselves and they've got their own calculations, then by all means leave me a comment down below and I'd love to hear what you've got to say. So something to consider. Some IVA companies will offer cheaper fees than others, but the net cost to you will be the same. So what you will save in fees, you will still pay to the creditors. So don't let cheap fees determine which IVA company you choose. So now that your affordable monthly payment has been determined, the insolvency practitioner will then hold a meeting with your creditors and ask them to agree to the proposal. Now, in order for the proposal to be accepted, at least 75% of your creditors by value have to agree to it. If they do agree, then the proposal is accepted and is legally binding straight away. Once the proposal is accepted, your creditors will freeze any interest and stop any further charges taking place. They will also agree to write off any remaining unsecured debt when your IVA is completed. A review of your circumstances will be done each year and a new income and expenditure form will be requested. Now, if your circumstances change considerably, then your payment may increase or decrease. This is what happened to me. As my car payments finished about a year into my IVA, my payment then increased by £300 per month, which is the amount I was paying for the car. My payments went from around £300 per month to over £600 per month. Can payments increase or decrease? One of the main selling points from IVA companies is that your monthly payments are affordable, meaning that you should be able to make your payments without drawing on the funds you really need to pay for essentials, from food and utility bills to mortgage and rent payments. Your payments might change if your circumstances took a turn for the worse. If your income dropped or your essential expenses increased, your IP might be able to negotiate an IVA variation. Now note the word might, you will see this a lot in IVA companies' literature. A variation is an official and legally binding change to the terms of your IVA, which would have to be approved by enough of your lenders, the same way as your original IVA proposal was. Your IP might propose, for example, that you're allowed to make smaller monthly payments for the rest of your IVA, but make them for longer, so your lenders still receive the same kind of return. Now, if you fail to meet your IVA commitments, you could be at risk of bankruptcy. Similarly, if your income increases or your expenses drop, then your payments could be increased. You're obliged to tell your IP of any income increases, and you're also obliged to inform them of any windfalls that you may receive, such as bonuses from work, inheritance, compensation, etc. Now, you will most likely be asked to pay all or part of this into your IVA. As the agreement is over 5 years, then there is a very good chance that your circumstances will change over this period. If they worsen and payments become unsustainable, then an IVA variation is required, and your creditors will have to meet again to vote on the new proposed payment. Depending on how much your payment decreases, the creditors may vote against your proposal, and the agreement will fail, and you're once again liable for the balances outstanding, which could mean you could still go bankrupt. By the same measure, if you do not keep up on payments or default on payments, your IVA will fail. What are the pros and cons of an IVA? Taking out an IVA will have a negative effect on your credit score. I personally watched my credit score drop massively once I entered my IVA. Even though I had significant debt before taking out the IVA, I still had a good credit score, as I was making regular payments on my debts and not really in arrears with any of my creditors. But there must be some benefits to an IVA, right? Well, thousands of people have reported that being in an IVA helped them out massively and got them out of some serious debt, and they saved some money, didn't have to pay back all of their debt. But for every person who has a positive thing to say about being in an IVA, there is another who will say nothing but negative things. Here are 10 supposed benefits of an IVA and my thoughts on them. Protects your assets if you're a homeowner. Your house might not be at risk. Then again, your house might be at risk if your IVA fails. Interest is frozen, which means your debt will not get any higher due to interest charges. You only pay what you can afford. Yes, but the IVA company will make sure that what you can afford is the absolute maximum, leaving you very little to live on. You will make a fixed, manageable monthly payment. Well, this is not always manageable. Creditors cannot harass you for payment. Well, if your IVA fails, they can. It writes off debt. It can potentially write off debt. Reduced social stigma. Not really. It holds the same stigma as bankruptcy as far as I'm concerned. Better employment options, unless you work in finance, and then you may struggle. Protection from bailiffs and other legal action. Again, only if the IVA doesn't fail. Legally binding. Yes, it is, but if you default, then you will be forced into bankruptcy, and no legal action will help. And here are 5 drawbacks to an IVA. Your name will be placed on the insolvency register, which is a public record, searchable by anybody. Your debt will not be private. Your credit rating will be negatively impacted for up to 12 years. You will need to follow a strict budget and you will suffer. If you're a homeowner, you may be asked to release equity from your property. If you have a windfall, lottery win, inheritance, bonus at work, etc., then you will have to declare it and pay it into your IVA. Alternatives to an IVA. Now, there are a number of routes you can take to get yourself out of debt other than an IVA. Here are some alternatives. Now, bear in mind that there are different qualifying criteria for each of these alternatives, so please check if you qualify using the links below. Administration order. This is for debts less than £5,000. Debt relief order. This deals with debts of less than £20,000 for England and Wales and less than £15,000 for residents of Northern Ireland. Protected trust deeds. Deals with debt above £10,000 for residents of Scotland. Debt management plan. Deals with debt of any size. Bankruptcy. Deals with debts of any size. Your assets are at risk with bankruptcy, but if you do not have any assets, then this may be a better option for you. Here are 6 things you need to watch out for when speaking to an IVA company. Number 1. There are dozens of IVA companies operating in the UK, all competing with one another to get you on board. They spend thousands advertising their service, so it only makes sense that these companies will have banks and banks of salespeople, all trying to convince you that an IVA is your best course of action to get you out of debt, regardless of whether it is the best option for you. It's a sales pitch designed to take your money. The company will make money from getting you into an IVA, and the salesperson will get a commission. It is a business after all. Number 2, you'll be told that you will be debt free after the IVA. This is true if you keep up with all payments for 5 or possibly 6 years. If for any reason the IVA fails, for example if your circumstances change drastically, then you could still be made bankrupt. Number 3, you'll be told that you can write off up to 80% of your debt, and in some cases even more. But it all depends on what the insolvency practitioner determines your disposable income to be. As mentioned earlier, the IP will adjust your expenses to maximise your payment. And if you're a homeowner, you'll be asked to release equity from your property. So you may actually pay back all of your debt, and on top of it, thousands of pounds in fees to your IP. Number 4, you will be assured that you will only pay back what you can reasonably afford to pay. But again, this figure is determined by the IP. They will tell you what you can and cannot claim as expenses, and they will make sure that they leave you very little money to live on, so as to maximise the amount payable each month. What you think you can realistically afford to pay to your creditors each month and what your IP thinks you can pay will be miles apart. Trust me when I say this, after the IP has calculated your income and expenditure, you will have no money left at the end of each month. Nothing. Zero. Zip. You'll be skint and you'll find it very, very difficult to live a happy life. Number 5, you may be told that an IVA will repair your credit rating. This is not true. Being in an IVA will not repair anything. Your credit report will be very poor for a long time. Only after 6 years from your IVA ending will your credit start getting back to normal. That means you'll be in an IVA for 5 to 6 years, during which time your credit rating will be shot. The IVA will remain on your report for a further 6 years after the IVA ends, although it will be marked as complete, but this will still affect your report. You will have a very hard time getting any form of credit for the next 6 years. That's 12 years of poor credit. 12 years of struggling to open a bank account, getting a credit card or store card, getting personal loans or HP, or even getting a mortgage. Now, I completely understand that it was having credit that got you into debt in the first place, and you won't want to go there again. But it is nice to have the option, if needed, especially when it comes to getting a mortgage. Also, having poor credit can affect you in many other ways. See my other video on this. Number 6, the IVA company will tell you that the stigma of an IVA is better than the stigma attached to going bankrupt. They may tell you that if you opt for bankruptcy, then your details will be published in the local newspaper. But this is not true. It hasn't been true for many years. Both bankruptcy and an IVA will, however, be placed on the insolvency register. So for those of you who want some real life experience and information, here's my story. So I entered an IVA in 2006. Now at the time I had around about £26,000 worth of debt from credit cards and unsecured loans. I was juggling payments each month, trying to make the minimum payments on each account, but the interest was just crippling me. Minimum payments were barely touching the capital. Now I looked into different ways of reducing my debts, and while searching the internet I came across a company called Debt Free Direct, who offered a solution called an IVA. I'd never heard of an IVA before, so I entered my email address and phone number on their website and waited to hear more. Not long after, I received a telephone call from a very friendly sales advisor who displayed elements of concern and charm and lots of sales patter. I was sold on the idea of an IVA almost instantly, and I felt an instant sense of calm and relief knowing that I was doing something about the debt that I had. Little did I know that the next 6 years would be the toughest, most grueling, unhappy times of my life. I barely had any money to live on. Every spare penny that I had was paid into the IVA. Any pay rises were immediately snapped up. Any bonuses from work were snapped up. Now, my initial payments were around about £300 per month, which I thought was a lot. But after about a year, they increased to almost £700 per month. Partly because my salary had increased, and partly because the HP on the car loan I had come to an end, releasing £315 per month. I couldn't keep any of that additional income. Now, at the end of 5 years, I was asked to remortgage my property and release any equity. My mortgage provider wouldn't let me take out a new mortgage with them, and no other mortgage companies would agree to a mortgage either. The IP then asked me to take out a loan secured on my property via a loan company who they recommended, the name of whom I can't remember, but I am sure they were linked to Debt Free Direct. Now, why would anybody claiming to help you get out of debt ask you to take out a secured loan on your property and put you into more debt? I outright refused to take out any loans, so I had to make an additional 12 months payments. Midway through the 6th year, I was also asked to make a claim for PPI against all of the creditors who I had taken out loans and credit cards with. The IP said that they would do this on my behalf, for a fee of course, or I could do it myself. So I chose to do it myself, and it was a huge undertaking and very stressful. I received PPI compensation from a handful of these creditors that totalled maybe £8,000. Now, this money went straight to Debt Free Direct. I didn't receive one penny of that money. But what made things worse is that Debt Free Direct didn't send me any information as to which of my creditors the money was distributed to, despite numerous requests for this information. I emailed and telephoned for months after my IVA ended and didn't receive any information. Now, this seems to have been the case for lots of people who all claim that Debt Free Direct kept that PPI money. Debt Free Direct were rude, very condescending. They spoke to me like a child for the most part, and other than the initial conversations before I set up my IVA, they were not very pleasant at all. Debt Free Direct have since gone into administration and have been taken over by a company called Aperture IVA. Now, I don't know anything about Aperture IVA, but their reviews are mixed on Trustpilot, with 48% excellent reviews and 42% bad reviews. So that's almost one good review to one bad. Now, you'll find many of the other IVA companies have similar reviews, so personally I would be very, very wary about entering into an IVA with any of these companies. Having said that, everybody's situation is unique, and an IVA may be your only option, but I would recommend that you look into other ways to reduce and clear your debt before taking out an IVA. I knew within weeks of setting up my IVA that I'd made a huge mistake, but I was legally obliged to continue. If I had my chance again, then I would definitely go down a different route, probably a debt management plan, but we live and learn. So to recap, here are some alternatives to consider before taking out an IVA. Administration order. This is for debts less than £5,000. Debt relief order deals with debt of less than £20,000 for England and Wales and less than £15,000 for residents of Northern Ireland. Protected trust deeds deals with debt above £10,000 for residents of Scotland. Debt management plan deals with debt of any size. Bankruptcy deals with debt of any size. Your assets are at risk with bankruptcy, but if you do not have any assets, then this may be a better option. Also, take a look at the Money Advice Service website, as they have tons of information that could help you. As always, I need to clarify that although I have worked as a financial and business analyst, I'm not a financial advisor, and I would always recommend that you do your own due diligence and take advice from a financial advisor, accountant, or solicitor if needed before making any big decisions.